Hello everyone, and welcome again to our podcast. I'm Toon, Chief Investment Officer of Asia Pacific Equities at RHB Asset Management. In today's episode, we will be talking about the expected GDP growth rates globally for 2020 and 2021, in particular for Asia. In addition, we will also help our listeners visualize the size of the fiscal stimulus and quantitative easing that the major countries have announced so far to mitigate the negative impact of COVID-19. In March 2020, we saw the fastest bear market in history. It took just 20 trading days for the Dow to tumble 20%. Past 20% declines from the peak typically took 150 to 200 days. But since late March, we have seen the markets climb 15% to 25% from the lows. We think this sharp rebound is due to three main reasons. Firstly, the markets were oversold due to the fast and furious panic selling in March. Secondly, governments all over the world have unleashed an unprecedented amount of fiscal stimulus and central banks' balance sheets expansion. And thirdly, news of possible vaccines and treatment has brought hope to investors. However, in our view, unless a vaccine or treatment can be found quickly, if not, we will be looking at a synchronized global slowdown in 2020. Incidentally, on 6 April 2020, the IMF, or International Monetary Fund, updated their global GDP growth projections for 2020 and 2021 to take into account the negative impact of COVID-19. IMF expects the global economy to contract negative 3% in 2020 from a growth of 2.9% in 2019, before rebounding 5.8% in 2021. In particular, advanced economies will contract negative 6.1% in 2020, while emerging markets will only contract by negative 1%. In 2021, IMF expects the emerging markets to rebound 6.6%, while advanced economies will only expand by 4.5%. Note that the contraction of the world's economy of negative 3% in 2020 is far worse than the negative 0.1% we saw in 2009 during the global financial crisis. In this chart, we would like to highlight that even in a tough year like 2020, IMF expects the major emerging economies in Asia, like China, India, Indonesia, and Philippines, to grow, albeit between 0.6 to 2%. Conversely, the major developed markets like US, Europe, Japan, and Australia are expected to contract sharply between negative 5 to negative 7%. In fact, even the more globally exposed Asian countries like Singapore, Korea, Taiwan, and Malaysia are expected to do better than the developed markets. We think this shows the relative resilience of the Asian market, even as COVID-19 pushes the world into a global recession in 2020. But when the global economies recover from COVID-19 in 2021, once again, it is the Asian emerging markets that will lead the way. In 2021, IMF expects China to expand 9.2%, India 7.4%, Malaysia 9%, and Indonesia 8.2%. Meanwhile, the more developed markets will expand in 2021, but at a much slower pace. For example, US is expected to grow 6.1%, while Europe and Japan will only expand by 4.7% and 3% respectively. Governments all over the world are well aware of the impending global recession brought about by COVID-19. As such, we have seen a bazooka of fiscal stimulus by governments and unprecedented amount of quantitative easing announced by the central banks globally. For example, in terms of fiscal stimulus, UK has committed 19% of their GDP, while Singapore and Malaysia have committed 12% and 17% of their GDP respectively. US and Japan have also allocated 10% of their GDP as well. This level of fiscal stimulus is considered massive by historical standards. Furthermore, the amount of quantitative easing announced by the Bank of Japan, European Central Bank, and the US Federal Reserve in 1.5 months from March to 17 April 2020 is already more than the amount we saw for the full year of 2008 during the start of the global financial crisis. This whatever it takes approach globally has somewhat put a backstop on the slide in the markets, at least for the short term. More interestingly, the market has been excited recently about the news of possible vaccines in 12 to 18 months. However, to put things in perspective, typically, Vaccine development takes 10 years. It took 4 years to develop a vaccine for mumps and 5 years for Ebola. And we don't have a vaccine yet for HIV. This kind of tight timelines of 12 to 18 months has never been achieved before, although we acknowledge the massive amounts of resources that have been invested globally since the start of the year. According to the World Health Organization, as of now, there are around 70 COVID-19 vaccines in development globally. There are 3 candidates already being tested in human trials, of which 2 are by US companies and 1 by a Chinese company. In addition, a variety of drugs used for treatments are also being evaluated. A few do indeed look promising. Although we remain hopeful of a medical breakthrough, but it is tough to have any clarity on the medical front for COVID-19. In conclusion, it has been an epic stock market roller coaster ride over the last 8 weeks. But we will urge investors to stay invested, but to stay diversified as well in terms of asset classes. Rather than focus on the now, investors should embrace key structural themes that will play out over the medium to longer term, which will include China, Asia, and the technology sector. And with that, we have come to the end of our podcast. Stay healthy and keep safe. Thank you for your time.